Like if the
Right.
Fed's meeting on September 17th or 18th, whatever the day is, some point after that, it would be better. That's what typical consumer response would be, I think, right now.
Well, that's intuitively true. Here's what people don't necessarily understand about the way that the market works. So, well, they do actually. So, the market. So, we want to talk today about there's a Fed rate cut coming in September. It is almost September right now. It's August 29th. Fed rate cut coming. When can we expect rates to drop? Spoiler alert, it is not when you think.
What?
What? And I'll say it's a two-pronged answer. It's A, sooner than you think, but there's also impact that is much further out than I think a lot of people realize. So, and Jason, you're probably hearing this as well. What I'm hearing a lot of is consumers are saying, well, rate cuts coming in September, so I should wait for the rate cut in September to do anything. Is that
Right
is
after that, at some point after that, presumably is when it's going to occur. Like if the
right?
Fed's meeting on September 17th or 18th, whatever the day is, some point after that, it would be better. That's what typical consumer response would be, I think, right now.
So it is intuitive that you'd think September rate cut, we would expect for rates to drop after that. This is
Right.
not unreasonable.
Right. Like you said,
So
like the ticket example is good. Yeah, you can't really
yeah,
buy concert tickets till they're available. So you got to wait for the date that, it hits,
right,
right? Yeah.
right. And it is let me double check. It is September 18th. Uh yeah, September 18th is when we're getting the Fed conference and the Fed statement. So
Yeah.
September 18th. Again, while that's intuitively true, here's what people don't necessarily understand about the way that the market works. So, well, they do actually. So, the market is it is always anticipating. It is always anticipating what is coming. A
Right.
good example of this is stocks, for example. Sometimes stocks are valued based on what a company is worth, for sure. But a lot of times, like Tesla, for example, stocks are anticipating what the value of the company is going to be.
Uh-huh.
So the market is anticipating future value,
Earnings,
right?
or they're looking at revenue and earnings, stuff like that, that they know is coming, projected, and they'll react
Precisely.
accordingly. Yeah, they'll react accordingly. That's right.
Exactly. Exactly. The market is going to start to what we say the market is baking in the future rate cut. September 18th is when it's going to land. So the market is going to prepare itself for when that occurs. Okay.
Right.
So another way to think about this is the market in general does not like big or fast movements. So let's
Right.
say that, as you anticipate, as a lot of people are anticipating, the Fed is going to cut the Fed funds rate by 50 basis points, okay, half a point in rate reduction. So that's pretty big. So instead of it would be kind of like instead of jumping off a roof, let me put a platform down so I don't jump off immediately. I walk down. It's very much the same. Or like
Mhm.
tectonic shifts,
Mhm.
when there's little movements, not a big deal. But if there's a big movement all at once, that's where you get an earthquake. So to avoid seismic activity in the market, the market is going to slowly bake in the 50 or 25 basis point rate cut. So all of the improvement that we expect from the rate cut will come essentially prior to September 18th. The other half to this equation, which kind of goes into the nature of the Fed in the first place, their primary job, at least ostensibly, is to keep inflation low and keep unemployment low. Okay. And so their primary lever is Fed cuts or hikes in order to manage those two things.
Sure.
I was watching an economist, what was his name? His name escapes me, but I was watching an economist describe how long it takes for a Fed rate cut to actually stimulate the economy. So
Okay.
the reason why they would start to cut rates now is because A, inflation is under control, and two, unemployment is starting to go up. Okay.
Right.
So it was Jim Thorne. That's who it was. Jim Thorne. He's a private wealth management guy.
Okay.
And what he was explaining is that it can take up to 18 months for a Fed rate cut to have a meaningful impact on the consumer. Consumer debt is at an all-time high.
Right.
Um, Consumer spending down, unemployment is going up. Uh,
Mhm.
for business, for the benefit first to banks to then lend to businesses to then create jobs, that's a 6, 12, 16-month cycle before
Mhm.
the consumer experiences the benefit of these rate cuts. So while interest rates may be going down in the very short term, like within the next week or two, we may see rates continue to drop. It may be 12 months before the economy starts to feel better based on these rate cuts that they're going to start doing. So
So for that part, for the broader economy, you're talking about unemployment, you're talking about inflation. Those things have a longer fuse than mortgage rates because things like
correct.
mortgage rates, if anything, they may be a little in advance of these rate cuts. You see mortgage rates start to drop, and maybe they, like you said, baked in a little early, and then you'll see the result of that a little quicker or even early. Versus the
Exactly.
broader economy, you'll see like um, economic, broader economic impact. I would say like in these other areas later. Right?
Exactly.
Okay.
Yeah, exactly. Which um, is, I guess, there's good news, bad news. Good news is some segments of the economy will start to improve relatively quickly, maybe things like real estate.
Mhm.
Um, but,
So
but service oriented jobs, there may be much, like you say, a much longer fuse on the road to recovery for other industries.
like a
So,
like a like a rate cut coming up, like even a couple of rate cuts by the end of the year, you might not see
right,
much impact until like the end of next year, like maybe next Christmas or beyond, for some of these broader implications. But yeah, it's good news for us, hopefully,
right.
headed the right direction for our part of the economy that we care about, for lending and
Yeah.
for real estate. So
Because I think that a lot of people, there's also not just a misunderstanding about what it is that the Fed does when they cut rates.
right,
It because what they're doing is that they're cutting the Fed funds rate,
right,
which is a very specific thing. That is how much it's the overnight interest rate. It's how much banks charge each other to send each other money.
mhm,
So banks have minimum reserves that they need to keep. And if they're doing a big loan the next day, they may be borrowing money from another bank. And so by reducing the cost of banks doing transactions with each other,
mhm,
that reduces the cost that they charge to consumers. And
right,
so when interest rates are lower to consumers, then consumers do more. We spend more money, we open more businesses, we invest more.
mhm,
So that's how they stimulate the economy is by incentivizing banks to essentially lend more money.
right.
So
So like
and
yeah,
that yeah,
it's a common misconception that if the Fed is cutting rates, they're cutting like our rates that we're talking about in our business.
right.
Like they're cutting mortgage rates. Like it has no, it's not cutting mortgage rates per se. It's the
No.
impact on other banks, the impact on other lending institutions that causes rates to fall. So it's not like the Fed
Exactly.
is cutting mortgage rates. Obviously, they're cutting
Right.
it, the federal funds rate, which is tied to banks lending to each other, and it has a trickle down effect on other things. Yeah.
Exactly. It's actually a funny application of the concept of trickle down. The banks benefit, and instead of just pocketing that additional money, they actually do because the market is so competitive for them. They do pass it on to the consumer,
Mhm.
and because it is an incentive for them to get more business. So in order to do so, they charge lower interest rates, and then businesses come and get money from them.
Well, it's interesting. It's kind of like the thing we were talking about with this the NAR settlement stuff. People like a lot of the media said NAR was slashing commissions. Well, NAR has nothing to do with setting commissions, and so like yes, it's negotiable, and they've sort of forced some things to change in our industry, but they haven't done anything to change commissions. And so there's a common misconception on that front as well. Like people hear one thing, they go, oh,
Exactly.
well, the media, apparently, in that case, and maybe with Fed as well, the media really doesn't understand it either. They're not in the industry. They're not economists. They're trying to explain what they've heard, and sometimes it works and sometimes it doesn't. So, but it's similar.
Yes.
Oh, they're cutting rates.
Yeah,
Like
no, that's exactly right.
cutting mortgage rates, you know.
I do have people come to me often and they'll say, "Oh, the media said that mortgage rates are the lowest that they've been in 6 months," and that actually it may be true, in fact. But I just it's always good with anything in real estate, just like in mortgage. It's always best to vet anything that you hear in the media. Never take you always vet it with some industry professional. I don't care what it is. So
Yeah, no, like you
yeah,
said, the wise thing with anything you hear related to rates or how the market's going or any of that is to talk to someone who's in the business that's doing this every day. We can explain it very clearly, like this is exactly what you're in for. And it may depend on, well, it's like with my business, it would depend on what you're looking for. Like where in town are you looking and what price range you're looking. And in your case, it might be down payment contingent, credit contingent, right? Debt contingent. All these things play a factor in the rate you're going to get. You're not going to get the rate you see published necessarily. It may be lower or
right.
even higher, but it's
Yeah,
gives you a ballpark. It's not going to tell you until that you look at their borrowing profile. You're not going to know.
no, just
There's a lot of activity. There's a lot of activity there.
I know. Yeah, it's a lot of action.